Hello, folks. Brandon Chapman with you for another TheoTRADE video for Monday, October 23rd, 2023. Boy, it's getting spooky out there. It's the season, baby. But we have a pretty wide-ranging day of trading today in the market, and ultimately finished virtually unch on the session, with the S&P only down about 0.17%. And it begs the question, okay, where's the market going for the week? To the title of today's video is Treasury Bond Bears Capitulate in 5 words. So as we look at what transpired today, it can really come down to those 5 words. Let me just show you the quick tweet that came out by everyone's not so favorite Bill Ackman. He said, "We covered our bond short." Okay, is this the time to want to be long bonds? As we look at TNX for today, let's bring up the 10-year Treasury yield. Try that again, 10-year Treasury yield. Notice how we ended at the high of this. We opened at the high of the session. We finished near the low of the session. What is behind this move? Notice where we're tagging right now. We're tagging at 5%. In fact, last Thursday, I walked through a unusual option activity in the bond market. I discussed with our members a long TLT trade off of the low down here towards the lows anyway. This is a spread. We got filled at an 85.87. So again, we're still slightly out of the money here, but the premise being is that 5% could be a sticking point for people wanting to be short. And the idea is that at this point, we may see buyers come in at least temporarily. And so we're looking for the possibility of running towards 87, maybe 88. That gets you about a 38% retracement of the down move here. And so again, that 70-cent 85.87 spread, while backed off from the highs of the session today, that's up a little bit at the moment at about 15.7%. But the idea is that, look, we were anticipating last week in part because that 5% level, and coupled with the notion that there was some option activity going long bonds. And this was really kind of contrary to my position prior to that. In fact, I closed out of trades in HYG to the downside last week. I closed out trades in KRE today. I closed out trades in also IYR, interest rate sensitive sector, last Friday. Now, it might be early a little bit, but how do we address a market like this? And the point is that yes, we see bond bears capitulate, creating near-term momentum in bonds itself, and maybe some of the periphery that are very interest rate sensitive, and to some degree the market more generally, as we see communications up today, led by stocks like Meta, for example, which was up 1.74%. But the broader implications of what we're seeing in the bond market and the potential strength, near-term strength of the bond market, is not exactly bullish for stocks. In fact, let's go back to that tweet here for just a second. And there's too much risk in the world to remain short bonds at current long-term rates. What risk can that be? Geopolitical risk, war, recession. In fact, he says the economy is slowing faster than recent data suggests. And again, I don't know if he's right or not, but it certainly plays into some of what we began to see more recently in gold. With gold rallying after selling off with rates, it began to rally with higher rates on treasuries, yields on treasuries, bond market selling. Why? The outlook began to change. We went from reflation to stagflation. And this is going to be a relatively busy week for the market. And we look at, for example, let's bring a Forex Factory here, just for kicks and giggles, just showing us a few of the data points. We've got manufacturing and service PMI tomorrow. We got Powell on the docket this week. We have advanced GDP, right? So this is going to be for the third quarter. And the advance is the first estimate that comes out. It goes, there are 3 versions. There's advanced, preliminary, and final. So we get the first estimate, right, on the third quarter GDP, generally coming out about 30 days after, right, after the end of the quarter. We've got core PCE, supposedly the Fed's preferred inflation measure. And we've got revised sentiment this week, which is reasonably impactful. But the point is, GDP is a very, very lagging statistic. It's highly likely we could have a 4.5% GDP and yet still be in recession. And you say, how can that be possible? And all I got to do is point out 2008, where we had 4.1% GDP on the advanced number, only to get revised in a recession later on. So the fact of the matter is we can have this dichotomy of high GDP on the advanced number that may not necessarily get whittled down to negative in the next couple of revisions, but further revisions after that. So the question is the economy weakening substantially when we see right here that we're going from 2.1% previous in the last quarter to potentially 4.5% anticipated or forecast for the last quarter in the third quarter of this year? Makes you wonder, right? We have 0.3% core PCE up from 0.1% the last month. We're seeing inflation increase. And again, who is right in all this? Do we see manufacturing and service PMI in contraction being less than 50? And yet we're posting 4.5% quarter over quarter GDP in the advance. Again, this is very interesting data, but one thing we know here, this is heavily lagging. We could see the GDP, we could see the economy really starting to fall into the abyss and yet still post very high GDP numbers. I use this example all the time of why GDP is not a good predictor of the economy or of the market. But as we look at the market, what does this mean? If we are starting to see material weakness enter in, we may yet see strength in treasuries, which means lower yields. And all of a sudden, does treasuries become more of a classic representation of risk off? We've realized that both bonds can sell and stocks can sell over the last few months. So now all of a sudden, are we starting to reorder where all of a sudden we're going to see treasury yields down, indicating the economic outlook is slowing, and at the same time, we start to see risk off in stocks. Now, certainly seeing leadership in technology and cyclicals and communications. Well, that does not necessarily represent that, but we're up minimally. And one thing we know in terms of technology and communication, or technology and cyclicals in particular, those two areas have the highest beta areas in the last year. Those two sectors represent the highest concentration of high beta stocks over the course of the last year. And so when you see some sort of short covering, right, profit taking, you expect these areas to show some interim strength. But what does that mean though? That interim strength, once the short covering party's over, what you'll likely see is they resume their downside trend. Now, again, we're gonna be able to check some things, right? We'll see what the market can bear at the moment. But earlier in the session today, there was a 1.2 million trade. You can see that on Trade Flash up here. And I don't care, buy or sell, doesn't matter. But 1.2 million shares traded in one trade at 421.25. Now, this is going to create a significant level for the market, both as resistance and as support. Right now, we are below it, therefore resistance. If we're above it, that acts as support. And if we look intraday, we can see was that level respected at all intraday today? You can see it kind of acted as resistance here, broke through, acted as resistance again. So I anticipate we've rallied kind of back up to that area after the close today. This is a level to watch. Now, frequently, these can lead to inflection points. So if we can stay above it, we begin to rally. This may lead to a near-term bounce, right? We may initially respond positively to falling yields. In fact, if we look at the trade today, we'll just use the ES here. We'll go into a 1-day, 1-minute chart. You'll see exactly when that tweet went out. It went out at what? 7:45 Mountain Time. So you can see the reaction, the positive reaction to the market, to the notion that treasury yields may come down. And so being long treasuries isn't exactly a terrible thing here, right? As they may rally, and this may lead to some sort of risk on in the near term, or a better characterization is the fact we may just be in a little short covering, profit taking mode that could carry us a little bit higher in treasuries and maybe a lot higher when we eventually see the further downside in the market manifest and the rotation, if Bill Ackman's correct, towards Treasury bonds again. So now all of a sudden we go back to a rally in Treasury bonds and a sell-off. Is order about to be restored here? Again, it's a maybe a bridge too far with all of the spending, all of the planned spending, a lot of conflict going on in the world. Again, but that may only exacerbate the downside and may only increase the stagflationary forces. And what does stagflation mean? Stagflation means what? Slower growth. And again, we can't really look at GDP to indicate where growth is. Look at long-term Treasury bonds. So if we see what? Inflation still being hot, right? Meaning there's might be hot PCE or CPI, et cetera. But better yet, we may still see some expansion of the money supply in the banking space, some appetite for credit on the part of consumers and consumer spending. Whilst all of a sudden we start to see Treasury yields and prices of Treasuries going up, Treasury yields going down in that seesaw fashion. This may create, with lower long-term yields, Treasury bond yields, and relatively high inflation, this may lead to more of a stagflationary result. And this isn't exactly the most positive area for the market. But one thing we know is that, breaking 4% back here in Treasuries in August did not exactly bring a lot of positives here. If we go back to where we were beginning of August, back here breaching that 4% level, we've seen that the market has generally been weak as we've maintained that yield north of 4%. But eventually it may come down to not just interest rate adjustments or interest rate raises or an increase in the Fed funds rate and or yields on long-term Treasuries due to potential higher borrowing costs. It may start to come around is that the real economy is beginning to weaken, and it's the safe harbor of Treasuries at 5% that may bring about, again, that indication the market itself may be headed lower. So again, there's a lot of uncertainty here, but at least in the near term, it certainly looks like Treasury bonds have a pathway to the upside to maybe what, 88.50, maybe 87. The spread I threw out is the idea is if it can get up into this area, it certainly makes sense as a possible opportunity. And in fact, today in Treasuries, in TLT specifically, let's bring up this December expiration for TLT. This was an 87 and 92. So we're looking at out of the money out here. So let's bring up the time and sales down here. We'll clear out anything in here. But you'll see the 87.92 right here, 86. You can see that these two are put on together. So let's go in and take a look at the 15D expiration. And what do we see? 87 right here and 92. Now, again, this is reflecting potentially selling the 87, buying the 92. My guess is that's probably the opposite, right? There's probably some long put vertical long call vertical activity in here. And, but again, you look at the volatility, certainly the term structure is favorable in that as well to buy the lower vol, sell the higher vol. But I was still to kind of go against this and suggest it's probably a long call vertical, buying the 87 and selling the 92 in that. Looking at the upside here, 92.5 would get you to the 92 area, get you to that 61.8% level in the near term. So again, the idea is that it makes sense that bonds might see some pause, right, in the selling, maybe even a bigger rally, maybe a smaller rally. There's lots of ways to construct this trade, either targeting 87, 88, or possibly 92 in the coming months. And again, that's on the heels of stuff we saw last week, for example, in IEF that led to the trade I outlined for our members last Thursday to be long Treasuries and specifically TLT because of the liquidity and the potential for movement in there as well. Now, what does that mean for gold? I mean, if yields are starting to come down, prices of Treasuries going higher, gold generally performs pretty well on that front. And again, if yields are falling and prices rising for long-term Treasuries, that being more of a stagflationary type outlook, yes, gold's been on a really nice tear over the last couple of weeks. Could we see a 190 handle in gold here? The dollar strengthening minimally today vis-a-vis gold. And if we look at UP against the basket of currencies, the dollar was actually down today predominantly against the US euro / US dollar. So euro strengthening today vis-a-vis the dollar. The Aussie strengthening today vis-a-vis the dollar just a little bit. It's possible that the temporary strength in gold, weak strength in the dollar versus gold, may reverse and gold could head higher and test 190 today. Well, what does that mean for stocks like GDX? If the market is to pause, right, in terms of its pause and hold and start to rally off these lows, it makes sense that GDX would move sympathetically with rising gold prices and likely outperform in that scenario. So today we see kind of a long-legged spinning top or doji on GDX. And in fact, there was some pretty significant long call activity. You can see the 15Ds 31 here, the 15Ds 31. And again, there's deeper stuff you can look at. This isn't always just green means buy, red means sell, as we just looked at regarding TLT. But the notion here is that, again, this is strong buying activity, large chunks, almost $1 million trade there. This is not a retail trade coming in 9,800 contracts in one print at 89 cents. We start to look at 31, that's up here, right? So looking at a near-term bounce, you could look for a trade through today's high as kind of a signal, maybe pushing towards the low yesterday and more of an anticipatory move. But the good thing about GDX is that you come out here, let's say for a 15 December, 53 days out, the vol structure is not unfavorable. You could buy a 30 and sell a 32. You buy the lower vol, sell the higher vol. It makes that relatively cheap. In fact, this might cost you about 61 cents or so to buy a $2 spread for 53 days out. And all this has to do is get up to 32. Well, in fact, it's only got to get to 30.60 to break even. Now with it pulling back here, could you go 29.31? Absolutely, right? The 29 is at 34%, 31 is slightly less than that. So there's a slight impairment in that. It's probably going to cost you maybe about 85 cents or something like that. But fact is that's a $2 wide spread. And again, 29.85 here. It takes very little movement to get to your break even. We start to push at or through 31, gives you a chance to close it out. So again, a couple of different ideas here for GDX, just playing that long call vertical strategy, either at the money or out of the money, playing a weaker dollar in a stagflationary environment with yields falling, the dollar weakening, gold strengthening, again, does not exactly bring positives for the market generally in this scenario. But if yields are falling, although XLU did fade from its highs here, do we start to see more movement in utilities? It's possible, right? Nextera is coming up with earnings on the 24th here. So tomorrow before the market opens, if we see a little bit of a positive bounce, this is mostly one of the larger utilities companies. It's located in Florida, more of a pro-growth area. Volume has been dropping off in the pullback here. And today, option activity, so 3 Nov expiration out here at the 55 strike. So call option buying at the 55, anticipating maybe a little bit of breakout tomorrow. But again, if yields come down, I would expect utilities to move up here in that stagflationary bent. Utilities should outperform along with staples, which was kind of in the middle of the pack today. So looking at utilities tomorrow, and you can look around the periphery, like a Southern is coming up in a little bit, or just looking at XLU, the possibility in a stronger long-term treasury bond market, if the market kind of bases here, there may be an opportunity for utilities to rally alongside some of those high beta areas until eventually we see that short covering rally bleed out and eventually start to reverse. And then it's the time to start to get bearish XLK into a rally, maybe towards 167, maybe push size 168.50, looking at the downside and likely break of support at that point. But again, that might take a little while for that to play out in the near term here. We could readily see a little bounce off support. So looking at strength in utilities with treasury bonds rallying as well, gold stocks rallying too, that could be a combination that could play out in this environment. One thing that may not play out as well in a stagflation environment is oil, right? Oil prices today, /CL, oil prices rolling over. The product depth, I mean, this is still an area that you probably don't want to short, okay? But you might look for opportunity in the pullback Look at the backwardation. We've leveled off just a little bit, let's say from September 27th, almost a month ago, but we're still dealing with backwardation in oil. We're still dealing with significant geopolitical risk. The risk is still to the upside here. While there might be opportunities to look at some pullbacks, the fact we're a couple days in this is still problematic. So we look at bearish activity in Oxy today, big drop. You know, stocks are a little bit different, right? They tend to price stuff in advance a little bit more, but this is such a big drop. I'm pointing it out just more from the perspective of, look, there we could definitely see some near-term weakness here. And I got to find it here. 1 December? Yeah. That 56 strike here for the 1 December being bought. Again, is this realistic to see, you know, Oxy at 56 again? Yeah, it's possible. But it might be something, at least for the time being, is that, you know what? Probably difficult to play. So we might acknowledge the fact that there's certainly bearish interest today in the energy space and Oxy looking at 56. And that might be a possibility. The term structure of oil futures suggests the risk is the upside in oil prices. Hard to really want to get short oil at this level. However, with a weaker dollar, if we're starting to see weakness in the dollar, particularly against emerging market currencies, I'll use the Aussie US dollar as a proxy. If this continues to strengthen here, this might be positive for the Chinese yuan and relatively bullish near term for Chinese stocks, like, for example, FXI. So if we get a rally here and a weaker dollar, this could allow FXI to gravitate upward. In fact, the trades in FXI is a 24 Nov expiration, 5,000 contracts out of the money at 28 here. So could we see a near-term bounce at 28? You don't necessarily need that, right? Even if we look at here, just a near-term bounce to say, for example, 26, 26 and a half. And as we look out, let's say at 24 Nov, or even better yet, let's just go out to December looking for a near-term bounce the next 53 days from its current level, 25.25. What about a 24.85 and a 26.85? Well, the vol's going against it a little bit. Don't like the 85 cents. Let's come in here. Let's try a 1 December. Or let's go 25 days. I was looking at one earlier with they've added some strikes here, and which one's better? 25 and a half, essentially just 25 cents out of the money, 26 and a half. So that might cost you there about, for a $1 wide spread, might cost you 34 cents. On a $1, you could extend it further up to 27.50. Probably wouldn't sell any higher than that, but the notion is you could construct a spread here. It's pretty flat in terms of volatility, starting at about the 25.85 strike. You could even squeeze in 25 and a half and even sell at 27. That balances out the vol a little bit of a drag, but $2 wide spread, 27 and a half in the near term. That essentially looks at a full retracement here. Break even is going to be somewhere around 26.10 or so in here. So it doesn't take a lot for it to break even, but looking for some near-term strength in FXI. You can even buy a call, maybe slightly out of the money, 25.85 out here for a December expiration, 53 days out. Well, folks, got to wrap it up there. That's what we got for today, and we'll catch you back